That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action in today's trade. Barbara Doran, as well as Yahoo Finance's Ali Canal, joining us here to break down the moves today. Ali, let's start with you on that close.
All right, well, another record-winning day here, Josh. S&P 500 hitting a new record here. We finished the day up about 0.4%, getting that fresh all-time high. Nasdaq Composite also able to move higher here, up about 0.9%. And the Dow just couldn't get it done. We saw a pop earlier today, but we closed just below the flat line here. And I want to take a look at some trending tickers because we got quite a bit of news today, in particular on the trade front. And you'll see that Nike was a big winner today. President Trump announcing a trade deal with Vietnam. And why this is important for Nike is that Nike has been diversifying its business away from China. And this happened during President Trump's first term when U.S.-China relations were a little choppy then, just like they are today. So the fact that we have this deal now with Vietnam is a good thing for Nike and also some other retailers as well. Lululemon and On Holdings, for example, seeing a bid in today's trading session. And then if we flip over to some of the sector action, you'll see a mix of red and green. We have energy, materials, and tech leading the way higher. Financials, communication services, utilities, and healthcare are the biggest laggards of the day. And then let's give a shout out to Tesla, right? Tesla has been struggling over the past few trading sessions, but we were able to see a pop of about 5% today. Now, this comes after the company disappointed on deliveries, but they did produce more vehicles than expected. So that was able to lift shares. But let's remember that it's been a bit difficult over a 10-day period. You'll see those declines, and we, continue to track a company like Tesla, which CEO Elon Musk, all eyes are focused on his leadership and everything he has to say about Trump's one big beautiful bill. And unfortunately, Tesla sometimes is caught in the crosshairs of that. So a lot of individual news movers today. We've been tracking a lot over this past week, and that sets us up for the crucial jobs report tomorrow. And then, of course, markets will be closed for the shortened holiday trading week with 4th of July. Josh?
Thank you, Ali. All right, Bob, I want to bring you back here as well. So as Ali was saying, so Dow finishes basically flat. The SPX tacks on about 0.5%. The Nasdaq's up about 1%. Small caps up about 1%. What do you make of today's trade?
Well, I think it started yesterday. We had the end of the quarter, on Monday, and we had the stock market has made a V-shaped recovery, extraordinary recovery, back to new highs, since the sell-off in April. And so I think at 22, 23 value times forward earnings, I think the market's due for a pause here, and yet you still have so much money on the sidelines. I thought a lot of people, institutional investors, were caught flat-footed, so they're trying to get in. And so what happened, I think, started yesterday was you saw a rotation out of the high momentum names into the laggards, into small caps, and that's even value. But I think that's going to be short-lived because things have not really changed, in terms of the economic outlook. You're starting to see, and you saw the numbers in the ADP this morning. You've been seeing a softening in the labor market, but it's not dramatic. Doesn't look like it's going to fall off a cliff. We'll note more tomorrow when we have the non-farm payroll numbers, and that's going to be unemployment. Could go up to 4.3% from 4.2, but basically, labor is clearly softening, and we'll see. We still don't know the impact of the tariffs, and we don't know when Trump. We have this this tariff deadline on the 9th. There'll probably be some extensions. There'll be some declared victories, and people will be able to start to sort through it. But the real winners here will, I think, continue to be the big cap because they can absorb these things. They can push it back on their suppliers. They can take a little hit to their margins. They can increase prices a little. It's the small businesses, which you saw this morning, the ADP numbers, that are getting hurt the most because they don't have that flexibility. So, and then we have earnings starting in another few weeks, and that's going to be the big banks. Which
when you think about that Q2 earnings, Barbara, do you think that's a positive catalyst for the market?
I think it can be. Yeah, I think people are not expecting things to fall off a cliff because, we had this 90-day pause with 10% tariffs, and the market has made new highs with that, assuming that that's going to stick, or there may be something on the margins. We still don't know if there's going to be tariffs on semis or on pharma, but we think it seems to be the market saying, okay, there's more bark than bite here from the administration. So earnings should be okay. You're not going to, I think you can see some little tweaking down, but it's setting up for a better second half and into next year. Even though the tax package, there's disagreement about that. I think it's not as stimulative as some think, but it's not going to be a drag, and it should get passed. And there's a lot of pressure for them to get it passed. And then you're going to have a focus on deregulation, which should start to help certain industries. We know that in the financials, how that's going to help. So it could be setting up for a decent next year, and if inflation stays tame, there is, and that's where the Fed is on hold. Although it's interesting, yesterday Powell said in some European meetings that they probably would have cut rates
if not for the Trump tariffs,
which is very interesting. And also when they had their meeting a couple weeks ago, they talked about probability of 2 more cuts this year. And certainly the probability for a September cut is now at 97, 98%. So that obviously is good for the markets. So ironically, if we start to see bad jump numbers, that could actually support the market, because then they'll say the Fed will be cutting rates and we start the virtuous cycle all over again.
Powell is clearly, he's be comfortable sitting tight for now, standing pat. Do you think that's the right call?
Yeah, I do. I think it's, he doesn't have the clarity yet. I think the economy is strong, weakening in some areas, but he's had the luxury, to be able to wait and see, are the tariffs going to have an impact? They should be. When you see it really is a regressive tax. It will affect demand, in what sectors and by how much, because the consumer on average is pretty wealthy right now. We've had a huge creation in wealth, since pre-COVID, people's homes, most people, I think it's 70%, own their homes outright or have financing under 4%. So the balance sheets are in good shape for consumers, and they still have jobs. That's key. That's why we're watching very closely. The Fed wants to see what the impact on all this on jobs, and certainly it looks like there's not big announcements on layoffs, but there's no real hiring either. And you just had the Bureau of Labor Statistics come out, and they surveyed all the metro areas, metropolitan, and almost 75% were seeing more job losses than job creation. So there's things like that are showing things are slowing down. Will it suddenly speed up? Doesn't look like it, but we don't know. And that's what I think the Fed is right to wait and see. And we should have some more information, some pretty good information in the next month or two, that the Fed can feel comfortable acting one way or the other.
All right. Well, for more on today's market action and what's to come for investors, let's welcome in here Scott Ladner, Horizon Investments Chief Investment Officer. Scott, great to see you. So let's talk about this market. You talk about the positives, Scott. Trump wants a deal on trade. You say taxes likely going down, deregulation, AI-powered productivity. It sounds great, Scott. So walk us through the negatives, Scott, as you see it, or the potential negatives.
Yeah, look, and I think Barbara did a really nice job sort of summarizing kind of what's going on right now. We agree with quite a lot of what she's already said. The negatives are kind of the obvious stuff. I mean, look, geopolitics is always going to be out there, but it doesn't really matter. The ferocity with which the market disregarded what happened in Iran, took even me by surprise. And I've been in some of this faded Middle East stuff for the better part of 30 years. But that was fast even by my standards. That's always going to be out there. And then, as Barbara highlighted earlier, labor market is slowing. Things are slowing, but there's a difference between slowing and slow. And it is, we're by no means in any sort of bad stretch right now. And the low-end consumer is feeling a little bit of a pinch, but almost tautologically, the low-end consumer doesn't really drive the bus economically in the United States. And so it is, it's a little bit of a challenge, but it's not that bad right now. So for us right now, this is kind of a 6 out of 10 economy, and probably a 7 out of 10 market outlook. So we're not going gangbusters, but it's not really, there's not that much out there to worry about right now if Liberation Day tariff levels don't end up prevailing.
How would you broadly characterize valuations here, Scott?
Valuations are in the neighborhood of fair. Look, the high value, high earning stocks are going to continue to lead this market. I mean, everybody worries about the top of the market. Everybody worries about concentration. Everybody worries about, are we going back into like the 1999, 2000 sort of levels of sort of bubbly Nasdaq-y sort of performance? That's the parallel everybody wants to draw. And I think we're more in like the 1994, 1995 period. This is a period where the tech is still going to lead, and it is going to be those high valuation stocks that are going to continue to lead. But those high valuation stocks are expensive for a reason. They have 30, 40, 50% margins in some cases, and they just make money hand over fist. And so high return on equity plus high PEs doesn't mean those things are a sell. It means they're actually still a buy.
In terms of other places you see opportunity, Scott, against the backdrop you kind of laid out there, infrastructure, you say, walk us through that.
Yeah, infrastructure trust is pretty interesting right here. I mean, you're starting to see a little bit of a bid to it, really just over the last couple of weeks. The big beautiful bill, will probably help on some of this because it'll help. It'll basically make capex free, and not free, but deductible immediately, which is a really big deal in terms of producing more stuff here in the United States. And then you have the entire AI power generation trade that kind of took off and then cooled off. But at the end of the day, we're going to need to produce quite a lot more power in the United States than we do today. And all of those things all tie into infrastructure being a pretty interesting place right here.
How about, in terms of Scott, looking ahead, you want to say U.S. focused, or would you also be eyeing opportunities overseas here?
We actually like overseas quite a lot right now, much more than we have in a while. This has been a sort of a standing thesis for us most of this year. A lot of it has to do with the dollar. We do have a modestly negative view of the dollar right now, and this is stemming more from flows than it is from either interest rate differentials or growth differentials, which are really the other two things that can typically drive currencies. But it flows right now in terms of just hedging activity that we're starting to detect out of foreign holders of U.S. financial assets. So the foreign holders of U.S. financial assets, or foreigners, hold $30 trillion worth of U.S. stocks, bonds, and treasuries. And if it becomes in their interest to begin to increase their hedge ratios on that, that means they have to sell dollars, and that's just downward pressure on the dollar that we have seen so far this year. And we think we're going to continue to see as portfolio flows sort of continue along that line. That's a big tailwind for international stocks. And so, while you don't have tech outside of the U.S., like outside of China and the U.S. really, so I'm thinking specifically about Europe. So we don't have some of the drivers of the market, we think, or drivers of the economy that are like really outside of the U.S. But for the next 6 to 12 months, that currency tailwind that you're going to get by investing in international markets, we think is going to be pretty strong.
Scott, great to see you and to have you on the show. Thank you.
Thanks, Josh.
All right, now time for some of today's trending tickers. We're watching healthcare insurance stocks as well as Apple. First up, healthcare insurers plunging at the announcement of severe Medicaid cuts in the Senate's version of Trump's big, beautiful bill. Centene appears to be the biggest loser today, but United Healthcare, Oscar, or among some of the others, also seeing their shares plummet. JP Morgan downgrading Centene at the news the insurer is pulling its full-year guidance for insurance plans sold on the Affordable Care Act exchange. Oscar Health receiving a downgrade from Raymond James and an underweight rating in newly initiated coverage by Barclays. So Centene, Barbara, they withdraw their financial guidance for 2025. They say earnings will fall short of expectations. Stock gets crushed. Your thoughts on that, and maybe the broader sector as well? Well, clearly there was some nervousness today.
Yeah, well, I think the stocks deserve to be crushed given the percentage of revenues they have from Medicaid. And it looks like, it's going back to the tax bill's going back to the House, but the Medicaid is going to be cut. And so the ramifications are going to be long lasting for these companies. The question is, I think in other names like United Healthcare was down on this. So United Healthcare maybe has 15% in Medicaid, and United has its own issues, but that's one that probably could be bought on any weakness here. But Centene, the downgrade I think is deserved. It's probably going to go lower. People will stand back. And so I think they're not buyable right now. At some point they probably will be when it's really thoroughly discounted. There's some light at the end of the tunnel, but that may have to wait until
avoid for now.
Another administration.
All right. Well, next up, Jeffries upgrading Apple from underperform to hold at possible upside for the company's third quarter. New data highlighting a 15% growth in global iPhone volumes in April and May, with Chinese demand after discounting pushing a 12% growth in March. Stemming from this, Jeffries raising its Q3 outlook for the technology and software manufacturer with an emphasis on 9% growth as opposed to previous 1% forecast. So Jeffrey does go to a hold, Barbara. They say Q3 could keep Apple stable in the near term. They say we believe tariffs driving pull-in demand and share recovery in China would drive June quarter revenue EPS growth. They're saying of around 8 and 10%. They expect only flat iPhone unit growth, though, in the second half. Average target on the street now is around 227. Stock is down around 15% so far this year.
Right, but it's up today in a big way. And I think that was the important news because, as you know, they have sort of blown the AI introduction. People have been waiting for that. I think it's really hurt their sales of the new models because you try to use Siri, which is their voice enabled AI, and it really doesn't work that well. Compared to a ChatGPT, you can go get that. So what the news today was that they might be partnering with OpenAI, with another outside vendor, and which would be smart not to do it inside. And that's why the stock was up usually, and could probably keep running from here, because so much is, I think people are holding off on that. And we have to remember the big part of the Apple story is that 25% of the revenues are services, and that keeps climbing. And that's their high margin business. And that's where you have, 2.3 billion in active users, and that keeps climbing. So I think Apple probably has a little more room to run here.
To your point, I did see analysts saying, Barbara, when that news crossed that maybe they decide to partner with OpenAI or Anthropic. There were at least some on the street saying that would be a smart bridge until they can start relying on their in-house technology.
Yeah,
for sure.
I think it would be, because they haven't been able to figure it out on their own. And they brought in a high-level guy, and that's they just keep missing deadline after deadline. So they have to do something, because they're really falling behind here.
All right, well, stick around. Much more market domination over time. That's coming right up. We're coming up on the July 4th weekend, and beverage stocks are in focus. Constellation Brands giving us a read on the industry on Tuesday, reporting first quarter earnings and signaling that consumers are cooling down on alcohol consumption. We're navigating how to play the beverage sector with the Yahoo Finance playbook. And joining me now is Nick Modi, Managing Director at RBC Capital Markets. Nick, always good to see you. So, first, when we talk about the beverage sector, Nick, kind of a high-level trend question I want to ask you. We do hear about this theme, Nick, that maybe alcohol is becoming less attractive for folks. Maybe more and more people, they want to reach for that non-alcoholic beverage, maybe cannabis. How real is that trend, Nick?
Yeah, Josh, it's a great question, and one that the industry has been asking. Look, I think it's a combination of cyclical and structural. I think the economy is definitely weighed on consumption in general across all the categories that I look after, not just alcohol, but snacking and even detergents, right? So I think that's probably 60% of the problem. But let's not kid ourselves and be naive. I mean, there are other categories that are tugging on consumers' wallets, right? And so we have to factor that in. Now, some of this comes down to the marketing from the companies and making sure that their brands are relevant in all the occasions that some of these other categories are siphoning off from, right? So think about the fact that, young legal age drinking men might be using DraftKings or making bets with their friends instead of maybe spending some money at a bar for some beverage alcohol products, right? Or gaming and buying products and services within the game. That all takes money out of the wallet. So I think it's something that the industry has to consider, but I don't think it's 100% of the problem right now. I think the economy is a bigger issue.
That having been said, Nick, I'm just curious, how does, for example, a Constellation Brands, which is a name I know you cover and I know you like, how do they navigate that trend, Nick? What levers do they pull?
Yeah, it's interesting. With Constellation, what we're finding is that they're actually generating a lot of new consumers coming in that are younger legal drinking age consumers. So they tend to over-index relative to the beer category on legal drinking age consumers. Why are they doing that? It's because their marketing is very relevant. We all know when I say the word Corona, I know exactly the three images that might be popping up in everyone's head. Modelo Especial has had very, very consistent marketing, as has Pacifico, right? All of these brands are doing very well. I think the issue for Constellation right now is a lot of the immigration rhetoric is putting a weight on consumer sentiment for Hispanic consumers, which tends to over-index to that portfolio. So in the absence of that headwind, I think you would see much better sales growth from Constellation.
So Constellation Brands, so that's one you like. Let's talk about one where you're more lukewarm, Nick. Boston Beer, you have the equivalent of a hold there. How come, Nick?
Yeah, our issue with Boston Beer is that, they've had some very good success on innovation. But more recently, their core portfolio is so much under pressure that the new stuff isn't making it up, right? And so for a company that is trading at a much higher multiple than what you see across the majority of the consumer goods industry that I cover, we just think that right now that the stock is past fair value, given some of the top line trends that they've been showing.
And another one, Brown-Forman, also a hold. No love for Jack Daniels, Nick. How come?
Listen, I think there's a problem with the Jack Daniels brand, in my opinion. I think the company has gotten away from marketing the brand. I think it's getting squeezed out between either low-end brands or higher-end whiskeys. And so I think there's a lot of wood to chop for Brown-Forman to get that brand back on track. On top of that, the entire beverage alcohol industry, as you mentioned, Josh, early on, has been under pressure. So that's just adding to their problems.
Now, I don't want to give the impression it's all alcohol over this long weekend. Plenty of people they'll be drinking soda too, Nick. Just want to get your thoughts. In that area, why are you telling clients Coke's a buy, Pepsi isn't?
Yeah, if you really think about it, Pepsi's more of a snack food company, right? Over, more than half of Pepsi's business is snack foods, and the snack category has been under pressure, and Pepsi or Frito-Lay has been losing market share. Whereas Coke, is 100%, beverages, and they've been doing very well. They've been gaining market share. And, one of your prior guests was talking about the weak dollar. Well, Coke has significant exposure to the weak dollar, whereas Pepsi is much more U.S. centric. So they're not as exposed or benefits when the dollar is weaker. So that's another reason why we think Coke continues to be an attractive stock.
Final question, Nick, just quickly. Your sector, your coverage universe, how exposed are they to the tariff threat?
It depends on the companies. Generally speaking, the beverage industry is exposed through some of the steel and aluminum tariffs. But again, that they're hedged. They have some pricing power, so they can offset if they need to. They can use alternate packaging sources like plastic instead of aluminum cans, or glass instead of aluminum cans. So there's a lot of levers that they can pull to mitigate. I mean, it's going to be somewhat of a pressure point, but there's productivity in pricing and package reconfiguration that they can use to offset it.
Nick, always love seeing you, having you on the show. Thank you, sir.
Thank you, Josh.
Well, the largest U.S. banks don't seem too stressed right now as they defy the gloom that settled over the industry when the second quarter began. For more on the optimistic tone in the banking sector, let's get to Yahoo Finance's very own David Hollerith with the latest. David.
So, Josh, the banks passed their annual stress test last Friday. The Fed gave results. And on Tuesday, they were able to reveal their capital plans. So this is just the annual exercise where they take the test. Once they get a sort of a notion of what their capital is from the Fed, they can then go by and
in other words, we saw this one coming. This was well telegraphed.
Yeah, but so compared to past years, I would definitely say that the banks have done generally better. And there's also some proposals that are afoot that are going to maybe potentially make their capital rules and these stress tests.
Such as what, Dave? What are those proposals?
So there's one proposal that would change their leverage ratio, essentially. And then there's another thing that to actually how the stress tests are implemented that would change too. And all this seems to be more favorable and more in the favor of what the industry has been calling for a long time.
What about earnings season, Dave? That's coming up. What do we expect?
Yeah, so it'll be interesting to see, how the dust finally settles out since April. Obviously, if you go back to April, a lot of deals of all kinds, IPOs, mergers, they were all paused. And through May and June, we saw sort of an uptick. So for the big banks in investment banking, we want to understand sort of what's going on with the deal market. Interest rates also haven't come down. And for big banks, that actually means that their margins might be a little bit thicker. So we're going to want to pay attention to that too. And then there's this whole notion of what the Trump administration is trying to do from a regulatory standpoint, and we want to hear more about that. There's a Fed conference in July that's also going to be a big focus there.
What about IPO activity too, David? The filings are becoming Figma, right? Filed for an IPO. What does that mean for some of those big banks?
I mean, it means they have more equity capital markets revenue, and that is actually the weakest part of sort of the investment banking deal flow, at least for the second quarter, I would say so far this year. And we've seen a couple really big IPOs. There's been a big focus in AI and then also fintech. And so whether or not that window continues to be open is really important. One interesting thing we've seen with all of the recent IPOs is that they're all sort of offered at a discount to their premium price. So, it's a buyer's market right now. And obviously, if IPOs continue to be that way, they'll do well and bankers will have more business.
All right, David, thank you so much. Appreciate it. And a big thank you to Barbara Doran for hanging with me for the show as well, of course, all afternoon. Barbara, we appreciate it. Any final thoughts, Barbara?
On the market, well, stay invested. That's my main thing. Don't try to time the market. Even though we're probably at the high end of the market for now, stay invested and stay in the AI-related stocks and technology. I think they should continue to do well. They are subject to profit taking from time to time, but don't be shaken out.
All right, wise words. Barbara, thank you so much. It was great having you.
Thank you.
That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell, but don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.